Good evening, everyone. I'm just going to give it maybe another minute to let the rest of the attendees come into the room, and then we can kick off this webinar ASAP. Hope you're all doing well wherever you are. Greetings from Sydney on my behalf. Managed to get out of Hong Kong for a little while, which is good. It's nice to be over here, and wherever you are, be it in Hong Kong or anywhere else, hope everything is well on your end. We have over 100 registrations for tonight's webinar, which is great. We're at about 37 right now. I'm going to let this go for another 30 seconds before we launch into it, just to make sure we have a critical mass of people that are signed up. Okay, well, look, I think in the interest of time, let's just get things kicked off and do an introduction of this particular session. So for those of you who are not familiar with me, my name is Benjamin Quinlan. I'm the CEO and managing partner of Quinlan and Associates, and I'm also the chairman of the FinTech Association of Hong Kong. You may have noted, for those who follow me on LinkedIn or who don't follow me but get annoyed by my posts that end up on your home page feed, we really recently released a report on the BNPL industry called Buy Now, Pray Later. It did get a lot of media traction, very interesting piece of work on the back of about half a dozen projects we did with BNPL firms in the region. I thought it was a really good idea to bring together some of the leading players in this space in Asia to get their perspectives on it, as well as understand what they're doing in this particular field. I want to just run through very quickly some of the logistics for this webinar so everyone is familiar with what we'll be running through. So the speakers for today are going to be, it's myself moderating. We also have Carol Hong, who's the Alternative Chief Executive and Chief Product Officer at Livi Bank, Trasy, the Regional General Manager at Atome, Soumyakant, who's the Regional Head of Consumer Lending for Southeast Asia at Grab, and Taiwan at Visa. You can tell that the speakers are not only high profile, but represent a good mix of different participants in the BNPL space, from banks to standalone providers to a super app to a payments company. So it would be really interesting to get all the different perspectives around what's going on right now. Some of the things that we'll be looking at, again, some of the evolving consumer preferences in Asia Pacific, the sustainability of the model, which has obviously captured a lot of media attention recently, some of the challenges being faced by BNPLs across their stakeholder groups, how they can address these headwinds, views on consolidation as we're seeing within the industry, both across BNPLs and across the value chain, particularly with payments companies, and then what the ultimate success factors and outlook for this industry will be in coming years. As mentioned, I'll spend the first 20 minutes just running through a presentation, which should synthesize our key views in the report. We're then going to do a 60-minute panel discussion, and we'll have a 10-minute Q&A session at the end. If you do have questions, feel free to type them in the Q&A chat box. I'll aim to address them at the end of the session, unless they're really like very timely, then I can ask them during the actual discussion. Otherwise, we'll leave all Q&A to the back end of this particular presentation. All right, so let's kick off. And I just want to make sure that we run through this presentation so we can set the scene. Some of you will understand BNPL, have heard of BNPL. Some of you may not. Hopefully this puts us all on the same page just regarding some of the facts and market data around the industry, particularly here in Asia Pacific. It's got a lot of attention in the West. I think it's now time to bring that attention back home to our regional shores. So let's start with the consumer finance market. And I think that the overall view here is booming household consumption, strong demand for credit, and a lot of that has seen the consumer finance market really grow by leaps and bounds in recent years. As at the end of 2021, about $5.35 trillion market size, which is effectively doubled from 2015. And you can see this spread across different countries, China being the dominant consumer finance market, followed by South Korea and so on. And what's the driver? Again, economic growth, growing middle class, rising internet penetration, so people can start using their mobile phones to source a lot of these consumer finance products, and then new product development. In particular, one of the things being buy now, pay later. Now, when we look at traditional consumer finance products, a lot of pain points, not just for consumers, but for merchants. I think for many of us who have got a personal loan in the past, a very poor experience, usually need to go to a branch at your bank, apply for a loan, fill out forms, long waiting times, can be very complex applications. And we often get slogged with really high interest rates and fees. And that's obviously a major, major pain point for consumers. If you look on the merchant side as well, there's also issues around low conversion rates. So a lot of merchants seeing their traditional credit products don't actually drive up the conversion of sales. The order values don't tend to increase. You were going to buy it anyway, right? And then generally, there's no real marketing support provided by traditional products such as credit cards. I mean, there is some, but not to the same degree that a merchant would obviously like to see, especially if they're paying a 2% fee on every transaction that's coming through their door via a card. So there's obvious pain points. And on the back of this, we've seen the rise of buy now, pay later as the business model. So the traditional consumer finance model you can see on the left. The important thing that you really need to pay attention to, the merchants, the consumers, and the lenders in the middle, is how these businesses make money. And if you look from the orange box, that's the most important. The consumer is repaying principal plus interest to a lender with via installments. That's the traditional model. We pay back the principal, we pay interest on it. But in a BNPL business model, the monetization aspect comes from the lender paying a purchase amount, and then an MDR is deducted. And an MDR, for those of you who don't know, is called a merchant discount rate. So it's basically the fee that the merchant pays as a result of having more volumes of transaction funneled through their pipes. And there's various MDRs in the market. I'll explain some of them a bit later in this presentation. So if you look at the BNPL landscape, the important thing that we wanted to start with was just different consumer finance dynamics across the region. You've got markets like Japan, Hong Kong, South Korea, heavy credit card ownership already, right? Even if you look at credit card ownership in Hong Kong, I think it's 2.67 credit cards per populace, right? For the people that own them. And then you go all the way to developing markets like China, Vietnam, Philippines, Indonesia, where credit card penetration rates are down in the very low single digits, like 2% for Vietnam and Indo. And why is this important? Because it ultimately has influenced the way that BNPL firms have been established and develop their propositions across the region. And we generally see if we have to segment these firms across a merchant-focused dimension, as well as a user-focused, so merchant from supporting merchants that provide necessity goods through the luxury goods, and then users is at the low income segment to the high income segment. We generally find this kind of a view, right? So the more established players like the Afterpays of this world down here in Australia, they've typically serviced lower end merchants in the past, but you can see the evolution of their business model with servicing much more high end merchants these days. And then down in emerging markets, players like your Akalaku, your Credivo, we've got Grab on here, obviously focusing on a much more unbanked or underbanked population, tend to be more emerging market specialists, right? Different kind of a proposition at that end of the curve. If we have to take a snapshot, again, of some of these players, you can see their launch dates, the amount of markets covered, the merchant count, and this was at the end of last year, and then the user base. So, you know, not insignificant numbers. Players like Afterpay with 16 million users, Atome, 20 million users, and we have the regional GM for Atome here. And then the user focus, again, you can just see a different kind of color code here for the low to high income segments, and then consumer staples, durables to luxury items. So there is some differentiation that we are seeing between the different kind of BNPL providers. If we drill down in more detail, you can see some of the mechanics that sit behind them. So for example, the service models, you've got different maximum limits, you know, for example, Afterpay, $1,000 US, right? If you go down to players like Credivo, it goes down to something like 210. Repayment tenure, so the amount of months, Afterpay 2 months, Payday 3 months, you've got 3 to 15 months, 1 to 12 months, depending on the provider, different repayment channels. Some charge handling fees, most do not. Some charge an interest rate, most do not. And then a lot of them do charge default and late fees as well. To the merchants, you can see the MDR here on the first line, merchant discount rate. Depending on the merchant, the spreads differ. So if an Afterpay may charge, for example, a merchant 3 to 7% of the gross merchandise value as that discount rate. And then as you tend to go towards emerging markets, that MDR decreases quite considerably, right? In the kind of sub 2% range. Different investors as well that have backed these firms over time, and then different models in terms of how they finance their business going forward. But I'll touch on this as I go through the presentation. So first things first, let's put it in perspective how much money is being funneled through the BNPL industry. Pretty impressive top line numbers. There's no doubt about that. The gross merchandise value, so the amount being actually spent through the merchants, forecast to reach about $361 billion in APAC by 2025. And if you look at how that trajectory has been growing over recent years, nothing short of pretty exceptional growth, almost doubling, right, every other year, at least 50, 60+% growth in the core markets as consumers start to gravitate towards BNPL products as an alternative way to source credit. Now, that all brings us to a very interesting point of great top line numbers, but our report, we started to unpack some of these challenges. And I think you are seeing some of these reflections going on in the media around where the BNPL industry is going to grow. Great top line story, but share prices have been struggling for many of the listed ones. Where is this industry going to end up? And we bucket this into 4 key challenges. The first one is on the consumer side. So some of the BNPLs we see still facing very high credit losses, customer acquisition costs being extremely high for a number of them, and then user retention, particularly for ones in emerging markets, being a little bit more challenging to get repeat usage of customers, right? On the merchant side, MDR pressure. So when these firms first came out, the MDRs, the charge being levied on the actual merchants was significantly higher. That has come down, as well as the expansion costs to actually build these teams and then get the merchants on board. Financing partners, again, high funding costs. They're not banks, BNPLs, except for Livi here, which obviously has much lower funding costs than a lot of the other players in this space. But they've typically needed to source finance through other channels or find partners to provide that financing, but it hasn't been cheap. And obviously with an inflationary rising interest environment, that will pose further headwinds. And then finally is really the regulatory standpoint, right? Heightened consumer protection requirements. We've seen a lot of this being led in markets like the United Kingdom, particularly in Europe. There's a bit more scrutiny being placed. We think that spillover effect will ultimately end up in Asia Pacific as well. So let's unpack a few of these. Credit loss, delinquency rates. Depends who you're focusing on, but the average credit card delinquency rates in APAC developed markets, somewhere between about 0.7 to 1.2%. If you look at the weighted average delinquency rates for the BNPL firms, it's sitting at about 1.5%, so almost 2x the low end of credit cards. Now, even some firms can spike out. We've seen even as bad as 15%. I think these are outliers, and I don't think any of the firms on today's call would be seeing any of those numbers, but we have seen it. And there are some challenges around, obviously, adverse selection. The principle is you service the underserved people that can't get credit, but naturally, as a byproduct of that, they are higher risk. KYC credit assessment being very important. Impulse purchases, because a lot of these are consumer products. Are people buying things on a whim? Do they have a capacity to repay? And then what are the delinquency repercussions? Because sometimes this isn't actually factored or baked into a formal credit score. So you can get your account frozen, but if you default, does that impact your credit score? In many cases, it does not. So there are some challenges here. And you can see, if you take, for example, the credit loss of 1.5% of GMV, let's just put it in perspective. It seems like, okay, you process $100 of value, you lose 1.5, but that's not the case. For a BNPL firm taking an MDR, because that's their revenue, of about 5%, that 1.5% credit loss actually translates to 30% value loss, right? So these numbers are quite pronounced, and there's a huge sensitivity to the MPL number in terms of the underlying economics of these businesses. So always very important that in order to cover capital loss, high transaction volumes are needed. So a very critical dynamic for firms to pay attention to here. User acquisition costs also quite high. A lot of BNPL firms have done a really good job in amassing a very sizable customer base, and hats off to many of them. But in order to do that, there's usually discounts, other kind of promotions and bonuses and packages that can be offered. And a lot of the time we see BNPL firms paying for this. Now, that's a natural part of any startup in a B2C world where you're paying for and acquiring new customers. But some of these numbers can be really quite high. So if you look at the user acquisition costs, on average, we're seeing that probably around the $28 range US, as high as about $55 for the people at the top end of that range. And then the discount rates as well being offered as a cash discount by BNPL firms, often like 10, 15, 20, 30% off a particular purchase of a good. But the cash rebates offered by credit cards, for any of us use them, usually 1%, 2%. The highest we generally see is maybe 5%, right? So different unit economics there. Retention. I think for many of the firms on here, the GMV from repeated users tends to be quite healthy, right? I would comfortably say that. But there are some firms out there with repeat usage being very low. And if you go to some of the players in emerging APAC, their repeat user rate is even around 25%. So that's everyone that you spent all this money on to acquire that don't come back, take a one-time discount, and then bye-bye, right? And that's obviously not what we want to see happening with many of these firms. It's consistency, it's repeat usage. That's what drives the unit economics of many of these businesses. MDR pressure, as I was mentioning, a lot of firms we spoke to when they first set up their BNPL businesses several years back were able to command double-digit merchant discount rates. I'm talking 10, 12% that they were able to charge merchants to facilitate these BNPL transactions. We've seen that compress over time. In the development phase, probably a year or two back, that compressed to about 8%, 6 to 8%. And we're seeing a lot more convergence in developed markets to somewhere around 5%. A spread of between 3 to 6 is more on the norm side. Now, it obviously varies depending on what kind of campaigns the BNPL firm runs. There is a case by case, but the general trend has been on the decline, right? As the BNPL market gets more saturated, as there's more competition. Merchant acquisition, as we mentioned, expensive. Usually, a lot of the BNPL firms have brand relations teams that work with international brands. They tend to have a local subsidiary and local BD teams to onboard local merchants as well. Tend to use ambassadors as well, brand ambassadors that go in store, encourage signups. All great for driving signups, but again, something to bear in mind in terms of the cost pressures of running these businesses. So again, something to bear in mind. And the purpose of this, again, just to be clear, is not to eviscerate the business. It's to really just shed light on the facts and data behind it. And this is why it's so important that we're doing this, because I really want to hear from all of the BNPL firms today how they're navigating through this developing ecosystem, because without a doubt, this is something that's here to stay. Funding costs, right? So different BNPL firms have different ways of funding the lending. Some have debt financing facilities, others equity financing, others create investment products. Some have bank deposits, the likes of the banks that have BNPL firms, and others use partner distribution, right? So it's basically working with different financial institutions and funding providers to extend the balance sheet as opposed to wearing that risk themselves. So these are very interesting models. And I think every BNPL firm in their heyday always, well, in their initial period, I mean, always starts with equity financing. It's obviously one of the things that has to be done, but they all know it's very expensive, and then they tend to go in different directions regarding bringing that funding cost down and finding a more scalable, cheaper way of funding these purchases for their end consumers. Regulations. As I mentioned, if you look down the bottom in Western markets, Germany, the US, the United Kingdom, all putting more scrutiny on buy now, pay later, right? So for example, the UK Treasury, believes BNPL should no longer be exempt from consumer credit regime and suggests further regulatory oversight. I'm down here in Australia at the moment, and I can assure you that there is much more scrutiny coming out of the government and different bodies around how to regulate BNPL. For much of the market in Asia Pacific, it's very much not regulated. So for example, in Malaysia, it's not regulated by Bank Negara, the central bank, as it falls under what they call a factoring agreement as opposed to lending, because there's no interest charge. I think we will start to see more convergence in this, more regulatory developments around this space, and ultimately something that the BNPL firms will need to be cognizant of in years to come, as I assume or predict that that trickle-down effect will start to happen in Asia Pacific. So what does that all mean, right? Depending on the players, some of the results can be challenging. And if you look at the revenue model of those BNPLs in developed markets, you take that revenue of $100 indexed, about 80% of that comes from the merchant discount rate side of the business. About 20% on average comes from the charging of late fees. But if you look at the cost elements, cost of sales, credit losses, marketing, funding, staffing, technology, a lot of the firms still, even the most advanced players like Atome in Australia, are operating on net operating losses of about 15%, right? Now that can get more pronounced depending on where you move in emerging Asia. Some players in emerging Asia, you can see of that $100 revenue item, the mix or the makeup of the fee is different. On average, about half comes from the MDR and half comes from late fees, right? So a lot more coming from late fees. But you can see the cost dynamics, particularly on the credit loss side, because they're focusing on higher credit risk customers, tends to blow out that picture a little bit more. I wouldn't say it's this bad for all of them. There's a handful in there that are obviously struggling, but there are actually some operating in emerging markets that are making a distinct profit at this point, right? So it all depends, but we have seen some of these numbers come out, and that's obviously a cause for a bit of concern. Now, on the back of all of that, I think the investor community has been cognizant of this. They've seen that these numbers have been wonderful on the top line, but we've seen Klarna, all these other firms start to show their annual results once listed, and there is a bit of head scratching. When will these firms take a profit? Because you get to see the revenue line go up, but you get to see the net profit drop in exactly a mirrored image, right? And that obviously scares people. And if you go to the Australian market, where you have probably the most advanced BNPL landscape, a lot of the share prices tanked considerably in 2021, and they've continued to take a bigger knock in the first quarter of 2022. So how do we solve for profitability? In our view, several things. You can optimize the business, you can look to further integrate it, you can expand. Now, I won't go into any of this in a great amount of detail because there will be too much to go through. But generally, optimization, the whole purpose here is to get a better understanding of your customers and optimize not only the value proposition, but the way you credit score them, the funding sources across the entire journey. And again, don't try and digest all of this. You can have a read of the report after if you haven't seen it. We're seeing a lot more of the BNPL firms starting to understand we need higher value, less risky customers. So once we establish our brand, we move up to higher value merchants and then higher value income segments who are inherently less risky. And we've seen that journey with quite a few firms, Afterpay being one of them. So you can see in 2016, they were targeting merchants like Crazy Sales, Peters of Kensington, which is a market. Then they moved on to department store retailers, Target. And then in 2020, you saw them start to pivot to the likes of Jimmy Choo, Armani, YSL, right? So quite a different profile of how they've been evolving, and clear evidence that in order to maintain that sustainability, higher value merchants and customers are the ones that they ultimately want to go after. Marketing campaigns I won't go through, but the only thing I want to really just point out is the fact that it's not just online channels, particularly in ASEAN, it's still heavily offline. So there's a lot of advertising and outreach that needs to be done through physical advertisements, as well as electronic media advertisements like television and radio, right? Conversion being very important. Again, I mentioned that point around brand ambassadors, hiring big workforces to get people to sign up. There is a lot more thinking now among BNPLs. Well, why don't we get our merchants to do that for us? Why don't we train them how to do it and get their people signed up, right? Get more people using BNPL. And a lot of this not only revolves around training them, but incentivizing them and making sure that they have the requisite, what I would say, not only incentive structure, but operating model to help them track and gauge how they're driving business for the BNPL firm that they're partnering with. User evaluation, again, it's all about credit scores. You want to reduce this. You want to reduce the non-performing loans. You don't want people defaulting. So the BNPL firms are among the smartest firms that we've ever seen that we work with around the credit scoring space. They know how to take not just traditional data, but literally your phone, your metadata, other things to get a good idea about your risk profile. And it's really fascinating to understand the kind of things that they look at and how that feeds into getting a clear view of your credit score as an end customer. And some of these models, I can tell you, are 100 times more advanced than anything I've seen at a traditional financial institution. So kudos to the BNPL firms there. User retention, again, all about keeping people on the platform. So engagement, browsing functionality, payment gateways, again, being able to create content, partner with merchants. There is a whole journey towards the super app ecosystem. And as you know, we've got Grab on here, which is very much in the super app league or on a journey to do that. So interesting to see how this will play out. And then funding sources, right? It's not just direct funding on your own balance sheet. I can tell you hand on heart that investors do not like seeing the risk on the books of these BNPL firms. They want it owned or managed by someone else, typically a bank or people that are in that game. Having credit risk on the books is not something that bodes very well for a lot of the buy now, pay later businesses in the region. And many of them are thinking about ways to offload this or get this away from their own balance sheets. Integration, I'll just quickly touch on this one. You're actually seeing some very interesting moves around integration. So there's quite a few mergers being announced between BNPL firms. That's really capturing the critical mass economies of scale point. The other interesting one is where you're seeing vertical integration. So you're having, for example, e-commerce platforms starting to embed BNPL within them. You're seeing payments companies see this as a very important mechanism to provide the gateway to make payment by offering a credit facility. And that's why you've seen the likes of, Stripe, Afterpay, Payd, and PayPal, right? A lot of the payments firms have been making acquisitions of the BNPL firms as a means to provide that credit solution along the payment journey. So a very interesting thought process around how the BNPL firms can pivot their model up and down that customer journey. I won't go through these parts, so we can skip through them. I think the final thing is really around expansion, right? So as BNPL firms think about what's next, do they leverage that credit expertise and start getting in new products like installment loans, payday loans, cash advances? Now, it's easy to say, it sounds like a logical thing, but the challenge is when you get into these new products, they usually come with licenses, right? Because they're different kind of loans. So all things to consider in terms of that journey, that product journey going forward. And then transferring the business model. A lot of the providers out there are starting to understand we've built up really good data, credit scoring engines. Can we actually sell this as software? Would traditional financial institutions be interested in working with us and paying us a SaaS fee and taking on that risk themselves? And then we get to de-risk our business and change our model entirely. Final thing is really around the implications, right? We generally think through the optimization, integration, and expansion point. If you look at the revenue enhancement and cost optimization that can come out of that, we feel that the current negative 15% operating margin story can turn into a plus 35% profit margin story for players operating in developed markets. If we index things and we look at what is realistic to achieve, we think for those operating in emerging markets, even on the lowest end, the picture, it depends on who you are, but it's not as rosy. It's a much more challenging environment than developed markets, just given the nature of the underlying customer. But at least that loss compression can be made quite drastically vis-a-vis where many firms are at today. And I think the last kind of few slides I want to end up on, 3 or 4 more to go, is let's look at how BNPL is becoming a more interesting growth prospect in terms of a payment channel. So you can see here, payment and credit distribution channels across different lines of delivery. Cash on delivery is obviously declined. Bank transfers down, debit cards down, credit cards down. Guess what? Digital wallets up, BNPL up drastically, albeit starting from a much, much lower base, right? So we're expecting a doubling of the proportion of transaction by 2024. And then you can see some evidence here, even with the payment service companies. Let's take the example of the United States. You can see in gray in credit card, and Japan and in Australia. This is the actual indexing of the usage of these payments. You can see it flat in the US from 2018 to 21. In Australia, it's actually declined. Credit card usage has come down vis-a-vis something like BNPL, which has skyrocketed. So it does paint a very positive top line story. Now, final conclusions are we generally see that the total GMV opportunity, as we outlined before, growing to about 361 billion from a base of 61 billion. When was that? That was 2020. So from 20 to 25, basically doing a 6-fold increase, right? And developed market players will probably process the vast majority of that. Nearly 80% of that GMV will go through developed markets. And we generally think that profit opportunity is going to be something that will evolve from what we see as a status quo of not that rosy. When these pivots are made, we do see the status quo negative number, and you can see that in 2025, both for developed and emerging, translating to a much more optimistic revenue pool number. And we do think a lot of the banks and the payment companies are going to start to attack this. And that brings us on to the conversation. So appreciate your patience with that. I know it took a bit longer, but hopefully it set the scene enough for you to really understand where we're going and to get some meaty views from the panelists regarding where they see this industry going in coming years. So let's start just with some of the more fundamentals around this. And I just want to know, because we've got different providers on here, standalone BNPLs, payment companies, and so on. Tell us, each of you, how does your BNPL work? Why is it different from everyone else on this panel today? And maybe we can start with Carol from Livi Bank.
Okay, thanks, Bank. Okay, I think our BNPL model is a little bit different from the mainstream. I have to say it's a tailor-made solution for Hong Kong market. And the differences between the mainstream, I will classify, I'll look at, three dimensions. The first one, in terms of the business model, we have a good balance between payment and lending, right? So lending for us is one module, and payment is also one module, and lending is as important as payment as well. So what does that mean is, for the customer, whenever they put through a transaction, on the buy now, pay later, they will get 3 months interest free, right? So it's either being funded by livi or will be funded by our partner, right? So for the customer, the same benefit. But for us, is when we fund this one, we will fund the 3 months, right, on par. But on the 2B model, when we talk with our merchant, we are asking them to fund for a little bit longer period. So for example, like starting from 6 months to the 12 months. For some of the merchant, we even go into 18 months as well. So you can imagine this will enable us to focus on a little bit more big ticket size and also more high-end product as well. I think this is something that your model has been telling us, like the next phase will probably, this is the space that we should address. But for us, right from day one, we're really clear that we focus on a bit more upmarket, bigger ticket size, right? So that's why when we bring in the merchant, we are looking for a little bit longer, financing period. So this is one. Payment and lending, two equally important module for us. And the second thing is, I believe for the buy now, pay later, mainly is on the selected merchant outlets, right? So over time, you will have to wait for the merchant network to grow. But for us, we bring in MasterCard as a partner. So basically, wherever you go, as long as the merchant accept MasterCard, you can put the transaction into installment. into buy now, pay later, right? It's either funded by merchant or funded by livi. So this makes our product a lot more flexible. So any merchant, as long as it's MasterCard covered and local, overseas, online, offline, anytime, 7x24, right? So comparatively, it's all your choice, right? So this is some fundamental difference as well. And thirdly, is because we are focusing a little bit more on the high-end market, bigger ticket size. So we do quite, proper credit assessment at the very beginning, right? So we will have a comprehensive assessment on their creditworthiness to make sure they don't go beyond their means. And also we have tailor-made interest rate and also tailor-made loan size for them, right? So I think fundamentally, these are the three things that is a little bit different from the mainstream. But one thing in common is we build extremely flexible platform on the mobile, right? So it's all digital and it's all at their control. Everything is, within reach and instant, right? So the very good customer experience and also very instant, hassle-free, simple, I think those common value, we have it as well, right? So a little bit different from the mainstream, but I think this is something that will good for the Hong Kong market. When we get into the challenges, I can share a little bit more why we shape a business model like this in Taiwan. Right, okay. It's basically to see some of the challenges we see in this market.
Okay, perfect. So that's your view from a bank-affiliated BNPL. Let's go to the traditional standalone, but one of the obviously sizable ones, Trasy at Atome. Why don't you tell us a bit more about Atome?
Sure. Hi, everyone. For full disclosure, I just landed in Malaysia, so I hope that there was no Wi-Fi lag. There's like a crazy flood, it just happened, like flooding and raining. But yes, so my name is Trasy, and Atomia, I hope most of you know about us by now. We are a buy now, pay later provider where users will be able to split the purchases into 3 interest-free monthly payments, and our merchants will get paid pretty much instantly. And I would say like what Ben said, like more standalone traditional buy now, pay later company when we started. So when we're thinking about how we are different from the other players like Livi Bank or like Grab Pay Later or even some of the standalone buy now, pay later providers, there are definitely a few differences. Number one is we have a very strong proprietary risk technology system. Our mother company is Advanced Technology Group, where we have actually started our business with P2P lending and also doing risk scoring and assessment for even banks and some of the corporate companies like Gojek and some of the well-known banks that we have been working with. So we have actually gathered quite substantial data about how to assess risk for users. And I'm very proud to say that comparing to some other buy now, pay later providers, we have one of the highest approval rate for the users, and also a very, very stable, I would say at the very low side default rate. Definitely not like 15% what Ben has mentioned in the report. We definitely won't be here anymore if it's like 15% default rate from the users. So that definitely a risk assessment system, proprietary system that we have. The second thing is our regional presence. With some hard work and dedication from the team, we were able to expand to 9 countries over the last 2 years across APAC. And what we realized is that a lot of regional merchants would really love to work with buy now, pay later providers that were able to actually provide a service in different markets. So we were very honored to be partnering with some of the regional merchants like Agoda or like Salora, Shein. And we also have the trust from some of the bigger merchants like Sephora, where they are available in different markets, and definitely some of the well-known brands like Sasa, Bonjour in Hong Kong as well. So very, very happy with the result that we have achieved over the last 2 years. And the other thing I would say is we are a startup. We are not traditional. We move very fast, and we constantly listen to our users and merchants and evolve our product from there. And if you are interested to join up with Atome, let's say you sign a contract today as a merchant, you'll be able to be online the next day. So I think the speed is something that we do really value a lot in our operations and how we evolve and listen to our users and merchants. Yeah, and and I think like if you guys haven't really downloaded our app, if you have our app on hand, you will notice that we're not just like a payment method. We have been trying different things to really provide more values to our merchants. If you go to our Atome app in Singapore, you will notice that there are different functions like Atome aspirations, and which is like a function where users will be able to see different content from influencers and be able to know the new trends of different products of that merchant. So I guess like to summarize, like risk system, the regional presence, and also our merchant network.
Very cool. Love it. Okay. Now let's go over to big payment juggernaut, Visa. How about you, Jenny? What's the view from Visa on the BNPL landscape? What are you doing different?
Hey, yeah, so for Visa, I think what's different for us is really the role that we play, because we ultimately is an enabler, right? We're a payment network. So we actually work with both the buy now, pay later fintech as well as financial institutions. So with the BNPL, what we do is, well, first of all, I think some of the challenges that's been raised, right? Like merchant acquisition. And user acquisition. So by helping our buy now, pay later fintech to issue Visa card, it means that that card could be accepted in any Visa merchants. We have been doing that with like Paydi, Affirm. So some of the players around the world to make their plans available in any Visa merchant. Sometimes it's only a virtual card, which is making the issuance a lot less costly. And also, of course, the Visa branded as part of Trust, right? Helping them to acquire users more easily. And also thinking about the credit loss challenge, we do also help buy now, pay later fintech to accept debit or credit card as a way to get back the repayment or installment, having a card on file. That certainly helps them to get their money back. So these are the kind of the two ways we help with the fintech side of things. At the same time, obviously, our main business is still serving banks, and banks are in the buy now, pay later space as well. In fact, there are over 2 billion credit cards around the world. Most of the banks, I would say, already offer installment, even though nowadays it's mostly post-purchase installment, right? You turn your credit card bill into installment. So what is really changing and challenging for these banks is how do they get into the at purchase installment area, which historically means they have to talk to individual merchants and set up bilateral agreements. And what Visa is now rolling out a new solution is allowing merchants to call APIs to find out for the card that was entered as point of sale, what installment plan is offered and displaying those at the merchant point of sale. So this is really trying to help the banks to also compete in the point of sale space more easily without those bilateral agreements.
Very cool.
So these are kind of the two areas that we are working on.
Makes perfect sense. And last but not least, Grab. So you guys have been grabbing the headlines nonstop. I'm keen to know, Dash, what are you doing in the buy now, pay later arena?
Thanks, Ben. So firstly, your report was very timely, and I endorse a lot of your thinking, not all, but most of it. So as far as Grab and BNPL is concerned, our approach has been driven by really two things. One is to have an ecosystem-led approach, because that's clearly our strength. And the second one is sustainability of the model is actually at the core of it when you think about what we are trying to build. So keeping that, those two principles in mind, some differentiation points are, number one, our product is not available to everyone. So our product is actually available to our most, engaged customers. And by virtue of doing that, we restrict our access and we actually use our proprietary model to what we call whitelist people who actually deserve it. And that model allows us to expand over time in a very calibrated way rather than just opening it out to everyone. So we don't have a concept of approval rate because everyone who has access to the product is actually approved. So that's number one. Number two is our product comes in two formats, and that is the ecosystem-based approach. One is what we call postpaid. And the reason for that is actually it drives a significant amount of value and volumes of our Grab other products. And that has a convenience angle to it. A lot of people actually like to have one single bill that they want for all their daily sort of and common sort of grab use expenses. And that's one product. And the other one that we have is installments, and even that is slightly different. People have 3 installments, we actually have 4. Because we wanted to give people an ability to actually spread their payments over slightly longer tenure. And I think that's the second source of differentiation. And I think overarching principle has always been to tie our entire business in the ideal way to provide this BNPL, whether it's payments, transportation, food, our loyalty program, rewards, and our wallet, and bring it all together to manage economics in such a way that we're able to build in a calibrated way to make it more sustainable and accessible to people. Of course, the overall principle of getting to the underserved and providing credit to the underserved is there, but we all know that it doesn't happen overnight. It takes time. And I think we are making a lot of progress in that. And as we expand to countries outside of Singapore and Malaysia, which should be happening a lot this year as well, we will do more and more of that.
Fantastic. No, I like a point around the interconnectivity of the ecosystem, because many people obviously understand BNPL is just one part of the Grab ecosystem and value chain. How you bring it all together is quite fascinating. Well, it's really interesting because obviously we've heard from 4 different BNPL providers or players who all have different roles, responsibilities, and business models around the way that they capitalize on this space. But I guess that brings me to a next question. So we've seen that the growth in BNPL has been there. We've seen some fall off in a few markets like Australia with cards. What do you think is going to happen in traditional consumer finance products? Will they go out of fashion? Will BNPL dominate? Will they bounce back? Maybe we can start with the card provider again. Jenny, what do you think?
I think the line is actually a little bit blurred sometimes, traditional credit card versus buy now, pay later, because you see also a lot of credit card having installment function, and some of them even set it up similar to buy now, pay later. They may have an installment card, right, where they automatically split your purchases into 3, just like buy now, pay later. So I think it's really kind of depending on innovation from both sides, right? So I think certainly we see the fintech being much better in user acquisition and marketing. But then, as you say, I think the banks are strong in the credit underwriting, right? And they have the funding. So I think it's just seeing the innovation from the 2 sides to see how they can fix their gaps.
Fair. Okay, so I guess picking on that bank point, Carol, what do you think? I mean, Livi may have debit card, credit card, BNPL. How does this all evolve?
Yeah, I think from the data that you share, right, I believe buy now, pay later really, catch a lot of interest from, from people from different markets. I believe it's largely because the customer experience is extremely good, right? And everything is instant, right? So they love this. So I'm sure, it will getting more and more popular. But I think on the condition that they don't have to pay for anything, right? So whether this model will take off or not, then will depending on the commercial model, right? So how exactly, the different party will be able to make economic sense out of this model, right? So I would think from consumer perspective, they love it, right? Because customer experience, everything is so good. And then, but how we'll be able to make economic value out of it? And the way that I look at it is, as what you rightly point out, is the, expansion and also something like integration. So I personally would think the standalone business model could be a little bit tough, right? But try to serve the customer something else, go a little bit broader on the scope, and also do some integration to lower the cost. I think this model will be sustainable, right? But we have to make economic sense. In particular, you need merchant to play another 2 to 3% more, right? So what is exactly the value for them that they're willing to pay it? I see it's quite challenging in Hong Kong market, right? Because Hong Kong, the margin is always so thin, right? So I think this will be the challenge. If we can make an economic out of it, I think the consumer love it.
It's very true. We also conducted, just to let you know, a consumer survey on people using BNPL in Hong Kong and credit cards in Hong Kong. One of the interesting insights that came out is most people that use credit cards, they don't need the credit. right?
Yes.
They use it because
Mm.
they want the points. And if I look at my own spending behavior, I've never not paid my credit card. It's on auto pay. I just use it to accumulate my points. So it's interesting dynamics depending on which market you're in. How about?
Yeah, we have some learnings, but when you have time, right, I can also share with you some of the findings that we've seen, because we do payment, also we do the lending part, right? We see some real behavior. And I have to say, our study is quite similar as the survey that you've done in Hong Kong consumer, right? But we see a little bit like different behavior after, you know, they are really using the product.
Yeah, interesting. Okay, Trasy, what do you think? Anything to add? Are you going to take over all of the traditional products and they're all disappearing?
I'd love to say we'd love to. However, I believe that definitely traditional credit cards and the new buy now pay later will coexist. This industry is huge. What we're talking about is like $1 trillion of business. And there's no way that one is going to take over the other. But one thing that I'd like to bring to your attention is, I think by like 2025 or 2026, 25% of the consumers will be Gen Z and millennial. Just think about the way how you sign up with buy now pay later, and we'll be able to get your credit instantly. It's so valuable to this group of customer who is actually mobile first. But if you're talking about my generation, or okay, maybe we're not in the same generation, but like our generation, holding that like prestige card, saying that you're like American Express, like top tier, really show some kind of status, you know, when you're paying. So I do believe that the convenience of buy now pay later will definitely add a lot of values to the Gen Z and millennial customers that are going to enter, or like even like younger customers, the boomer that are going to enter this the credit consumer industry. And when we're looking at like maybe outside of Hong Kong, like Southeast Asia, we still have a lot of underbanked and unbanked customers that are not accessible to traditional credit. How buy now pay later can really enter and crack that space is super important for us to scale.
Yeah, I couldn't agree more. It's that area that credit cards just traditionally have not been able to gain any meaningful traction. And that is the underbanked and unbanked segment of Southeast Asia, which is a huge population. Interesting point you mentioned on that kind of the branding, bragging thing of credit card, right? It's like whenever someone pulls out the Amex Black or something, it's whoa. But I guess in this day and age, people are pulling out their phones with NFTs on it. So who knows how things are going to evolve. Maybe I'll throw the next question to you, Dash, because, you know, I love the fact that you like some of the report, and obviously you don't agree with everything, but you know, we have a fundamental view around the sustainability of the business model, because we called that it's not a scale problem, it's a unit economics problem, right? That was our view. And I'm just curious to know from your view, do you see this as a sustainable business model? If yes or no, why? And then what do you see being done in future to kind of correct for this?
Yeah, no, I can speak from a Grab perspective, and what I mentioned was for us, sustainability at least is a core principle that we build the product and sort of around. And sustainability doesn't always come overnight, but there has to be a concrete and practical plan to get to it, right? Because upfront, when you're building a business, you will end up spending. I think that's natural. And in a way, the current environment that we are in globally is an acid test for a lot of people, because when the taps sort of dry up, really your business models get challenged. And I think when everyone else who goes for fundraising, I think investors will ask and question around sustainability. From a Grab perspective, actually, we have been the way we think about is, look, there are 4 effective big cost levers for us, right? Or for a BNPL player. There is a cost of funding. There is a cost of what you pay when customers repay, that you can call that the payment processing fee. There is a credit cost, which is probably the most important cost. And there is customer acquisition cost, which may not be one time, but it's a significant amount, because if people are repeating, like you mentioned in your report, that's a problem. I think on all these aspects, at least we try to leverage our ecosystem to make sure that the costs are under control. So the first one is credit costs. And I think I told you over there that we have a very calibrated approach to scaling, and we control who has access to our product. So as our model sort of improves and the genie of the model improves, we try to expand in a very calibrated way. And that's helped us keep our credit costs quite low. Second one is the cost of repayment. And there I think we have a wallet, and wallet we can use as a very effective low cost sort of channel to repay. In the future, we'll have a digibank, so we'll have access to CASA accounts. So we will be able to sort of use that CASA account to sort of repay. And I think that's important for that particular cost head. From CAC, I think, again, that helps to be a sort of a super app. We have a lot of engaged customers. So our incremental CAC is actually very, very low. We don't have to, if they see a product market fit and they value the product, they come. So our CAC is controlled that way. And I think the last cost that I mentioned was about repayment costs. And I think that has a lot to do with the fact that that I covered actually with wallet, but the cost of funds. And I think Grab, because of our parent and the size of our balance sheet, I think we're able to raise funds at a very effective sort of cost of debt. So this allows us to think of this as a more sustainable way. And of course, in the future, as we go, because we have these customers, we are able to sort of cover an end-to-end spectrum of the financial needs. So when we have our sort of digibank or any other license, we'll be able to sort of cross-sell more financial products to them. So I think that's how we look around sustainability. And I think if from an ecosystem point of view, I think it is possible to make this quite sustainable and even profitable in a sort of a slightly longer tenure. Yeah.
Yeah, I see the angle of the cross-sell that you're bringing out. And then I'll throw it over to Trasy at Atome, because its core product is BNPL. So then the question is, all right, so you're a standalone, you've got a huge customer base in the region. We've seen what's happened with the afterpays of this world. Is Atome facing something similar? How does Atome address this sustainability challenge that everyone's talking about?
Right, yeah, Ben, I think some of the things that you said in the report is really spot on. But when we're looking at CAC, right, CAC is really, whether it's high or low, it really depends on the predicted lifetime value that we're going to have from the users. So for Atome, buy now, pay later, it's just a starting point. We're not going to end here. Let's put it out there. We're not going to end here. But one strategy that's very, very clear to us is how do we evolve our product based on what we hear from our users and merchants, what they want us to do, and that can create them extra values in the ecosystem. And as you can see from the other players in the other regions, some of them actually evolved to be like a more shopping or like e-commerce kind of spectrum, and some are more evolved to be like a super app of financial. So for Atomia, I would say we are really going to test out different things in different markets based on what we hear from the users and merchants, and really bring more value to them and increase the LTV of the users as a whole. So I wouldn't say that now our CAC is high, definitely not. Like we are spending money very wisely. We definitely, if we look at like some of the competitors like going crazy with like discount, we don't do that. We are more on really looking at whether these are the consumers that we want longer term, and how we actually create values that can increase the LTV in the future. So I think that's what we're looking at.
That makes sense. Drive that value, focus on the right customers you think have the propensity to add more value, but do that through rolling out the appropriate products and addressing those needs. So sounds logical. Very keen to see how the Atome roadmap looks as you guys continue to move along.
Yeah, I can. Oh.
No, go.
Yeah, I can share a little bit of examples about what we evolve our product, right? Like we started off with like 3 months interest-free payment, and recently we just launched a 6 and 12 months to some of our selected merchants that really asked us for it. And during the pandemic in Malaysia, we have seen some of the traditional offline merchants going to be, they have to actually sell online. However, they don't have a website, they don't have, they're not on any online platform, but how do they actually move from there? So our team actually evolved immediately to provide a payment link for the merchants to be able to sell through social channels. They have a huge database of people that they talk to on WhatsApp, but how do they actually get that transaction through buy now pay later is that we just actually, evolve our product from there. So I guess that's the stand that we're going to take, and we're going to evolve with buy now pay later as a starting point.
Very cool. All right, let's pass it to Jenny. Payment infrastructure perspective, what do you think about sustainability? Credit cards are obviously very profitable, have been for a long time. How does it stack up vis-a-vis BNPL?
I think for buy now pay later fintech, right? As I mentioned, I think what Visa will try to help on their economics is really around kind of growing merchant base potentially, or user base more quickly without doing it at as much cost, right? So cross-border merchants, for example, that's an area where I think for a lot of the players maybe a little bit more difficult to get, but Visa do have a bunch of merchants across border. So by working with the buy now pay later fintech to issue Visa card, that's allowed them to grow into merchants across different markets. And that's kind of the same way that we work with the traditional banks as well in terms of kind of selling our installment solution. I think for both, to be honest, credit card issuers or buy now pay later, they face the same issues. I mean, market like Hong Kong, consumer are a little bit spoiled, right? They look for 0% interest, they look for the best rewards. So the user acquisition is high no matter where you go. So I think comes to retention is really about who can come up with the next kind of gamifications or usage of data that to really retain the users.
Yep, sounds like you have some background agreement as well with that. No, I love it. And what about you, Carol? Any final perspectives to add on sustainability coming as a bank to this game?
Yeah, I totally agree what Jenny said, right? And basically, I think payment is very important in our product suite, right? Because I think that is meant to be the sticky product for us. So basically, I would say the buy now pay later will give us a very good platform to really help us to serve our customer better on the payment needs. And this platform also enable us to extend it to the lending side of it. Because I think the good thing about credit card is, it enhances your cash flow. But the bad things of it is it's very famous for, high interest rate, the rollover is not transparent. You always lost sight on how much you owe the bank, right? The buy now pay later give the customer the transparency and also the discipline, right? So I believe it will help the whole payment experience. It's not like, who is taking over or what. It's one more option for the customer when it comes to payment, right? And as what, I just shared earlier, after we launched it for some times, we find out, customer really like the installment. And then they see the value of like paying a little bit like fee, but eventually that help you to enhance your whole cash flow and also, the buying power of your money. Right, so we also see, people don't mind to give a little bit fee in order to buy the cash flow, right? So this is something that, if you go and ask them to take up an installment loan, they will not do it. But if you pack everything into, one place, they have the option to pick and choose, and this is out of their own decision, right? They feel comfortable of it. So I would say this will be something that will be able to help us to enhance the entire payment and also the lending, experience for the customer and put it all together at their control.
Interesting. Okay. So I want to touch on the customer and merchant acquisition point a little bit more. When you look at a payment provider like Visa, massive merchant base and customer base already. So as opposed to acquisition, it's more conversion, right? They're getting people to use this product more in BNPL. If I take it then to like Trasy, what you're saying at Atome, and then Dash at Grab as the standalones. You said your customer acquisition costs aren't out of whack with some of the numbers that we were showing, and that's really good to hear. What's being done to address it? How do you keep these costs down? Is it getting word of mouth out? Is it a viral effect? Leveraging social media better? How do you wean off those kind of discounts and everything that obviously costs a lot to get going? What's the secret sauce? Go for it, Dash.
Okay. So I think, again, we have a fundamental benefit of obviously having in-app communication channels. So I think that really helps because customers, they come and they spend time on the Grab app, and we are able to kind of contextually sort of provide them with the right kind of nudges. So for example, they're about to book a ride, we'll say that, why don't you try pay later, for example, or they're about to kind of order food and they might not have enough money in the wallet, so we'll nudge them and say, why don't you pay later? Or some of the email communication that we have from our merchants, we say that there is this week going on, so why don't you come? So I think fundamentally, because a Grab customer is spending a decent amount of time looking at different things on the Grab app, we are able to catch them and contextually sort of nudge them. And that helps us to kind of at least get them to activate. So I think that's one part, I guess, of the story. Mostly marketing is also very, very targeted. So we do have in-house propensity models where we have seen the kind of people within our customer base who tend to adopt pay later. We have sort of back tested it and seen if we had gone back in time and started to do this, then were they likely to sort of convert? And that allows us to kind of have more effective targeting. And then we leverage the likes of your social media channels, Instagram, to provide those kind of contextual, again, contextual pay later sort of marketing, marketing assets. So I think, data that, and obviously engagement on the app helps.
Data. Carol, looks like you want to say something on this.
Oh yeah, and I think at Livi, right, the way that we do it is we don't underestimate the effort bringing in merchants and getting them to pay, right? So that's why from day one we build a platform that we'll be able to support it ourselves. Right, we bring in MasterCard, so all merchants are well covered, and then we fund it when we don't have merchant. So at least we get the proposition in good order day one, and then we start leveraging our ecosystem, starting from our partner IKEA, which is a very good and very targeted, I would say, a merchant. So because then we don't have to struggle with the chicken and egg, right? If you don't have the merchant, you don't have the customer. If you don't have the customer, the merchant will not be willing to participate. So we build, our own capability, and then we start one by one to bring in the merchant. And now I think we have quite a broad-based usage. Other than, IKEA furniture, we have good usage coming from home renovation, electrical appliances, furniture, and also we see good volume coming from high fashion and gadgets, and also when the social distancing was not that tight, we see good spending coming from staycation, right? So this is how we expand the merchant network, and I think that is pretty effective, because I think we have the track record, and then we approach another merchant and we grow it gradually.
How do we all feel this regulatory environment is going to evolve? Because we've obviously seen the West move quite aggressively in the past 6-12 months on this space. I'm curious to get the views of the panelists as where this is going to go. And it all centers around consumer protection, right? People falling behind on payments. Do they need to buy things? Are you encouraging conspicuous consumption? I've even seen some BNPL firms say, okay, we want to focus on providing medical services to people, like real necessities, right? Not splurging on televisions and the latest gadgets that they don't need. How do you think this is all going to play out in the region here? Our view. What do you all think about this? Maybe I can take it to Jenny, just as an overview first, and then get all your perspectives.
Yeah, sounds good. So I guess for me, because we in Visa, we work with the fintech or the FI, we kind of expect them to go through and get their own regulatory licenses. So not really necessarily Visa to solve, but at the same time, I think my personal opinion is that based on what I've learned, mainly from China case, right? You guys probably familiar with Alipay and Huawei. So that was when Alipay becomes so big in China, where everybody is using installment, and they government basically allows them to get really, really big, right? And then when a lot of people are not able to pay back, that's when the regulations come. So I feel the similar situation could happen in a lot of market. When you're kind of under the radar, they let you go. But once you get big enough, and then they're sealing some kind of big cases of like people not paying back their loans, that's when they may start to act. But that's my 2 cents.
Fair. What
Yeah.
about you, Trasy? Any views on the regulatory outlook?
Yeah, sure. I think first of all, buy now, pay later companies, or at least for Atome, we do not really treat interest rate as our revenue stream. When a user cannot pay us back, we do not really charge interest like the bank, where you just need to pay like a minimum payment and then you can continue to use a credit and then accumulate your debt and then like pay more interest and then you pay the minimum and then pay more interest. So Atome model is not like that at all. We basically stop there, right there. It's like when a user cannot pay back, we stop their account, they cannot use Atome anymore. So I think from like a regulatory perspective, I don't think that that's something that they need to be worried about. And when we're looking at like buy now, pay later checkouts right now, at least in Singapore, it's actually just about 0.5% of the total checkout of the ecosystem. We're just at the start, and I would say like the buy now, pay later companies, at least for Atome, the default rate is very, very manageable, and it's at a steady, it is at a very steady pace. So as long as the buy now, pay later companies are really getting users that are able to pay back to be on the platform and have that really good risk system, we will not be able to go into that, I would say the Alipay situation where a lot of users cannot pay back. So my view is that we are very happy to work with the regulator. And indeed, we set up like, together with the Singapore FinTech Association, we're working very closely with the Code of Conduct in Singapore on like, how do we actually put some guardrails, but not diminishing the growth of the industry.
Yeah, it's always a tricky area in finding the right balance of trade-offs, right? And it's like on the one hand you encourage financial empowerment and inclusion, and then the other regulators are saying, why are you getting people in debt? And you're like, hang on, didn't you ask me to do this and drive that inclusion point? So yeah, I take your perspective on this. I think it's an interesting balancing act. What about you, Carol, as a regulated bank?
Yeah, I kind of agree with Jenny. I think when buy now, pay later is getting traction, I'm sure that will attract the attention from the regulator, because I think they are always very proactive and also ahead of time they will think of what could go wrong, right? So I would say somehow there will be a point the regulator would think of like what they need to facilitate, right, in order that can protect the consumer more. And so as what you mentioned in the beginning, right, I think UK has already started the public consultation, and then for Singapore have just appointed the FinTech Association to do industry consultation, right? So I think they see the potential, they see, this is where this is heading towards. So I believe, somehow there will be some, I would say, probably some suggestion from them, but I don't think that will overkill the whole thing. It's just like in Hong Kong, right? We'll have like some governed by MA, but some governed by money lenders license, right? So I think they will have a proper I would say measures depending on the business model, but I'm sure there will be some attention coming.
Interesting. I'm keen to see how all this is going to play out. All right, well, let's move on to the kind of last juicy question that I want to ask around this, because it's that debate around scale and unit economics, right? And it's the point I was mentioning around the acquisitions. You're seeing consolidation happen. Firms are merging, BNPLs are buying other BNPLs, payment firms are buying BNPLs. How's this going to play out? What is the rationale driving it? Do you agree with what we're saying around capturing those economies of scale? Is it going to solve for unit economics? Maybe Dash, will go to you to get your views on how you see this ecosystem kind of panning out when it comes to industry consolidation.
Yeah, so I think industry consolidation will continue, but I'm not sure industry consolidation necessarily leads to such immense scale advantages that the business model gets fixed. I think we have to do much more. So, for example, example, I can, let's say, someone wants to, for example, sell out and we can acquire, but we'll get some new customers. But if you haven't fixed the core part of the problem, which is the business model and the sustainability of it, I don't think it's going to is going to address that issue, because it's not like FMCG or some cement company where scale leads to economies of scale. Here, I think it's much more to do with what you what are your revenue streams, what are your cost levers, and how you're actually managing it on a unit economics basis. So I think consolidation will continue, but I don't think it's going to change. It's going to solve for business model issues. So you have to think a lot harder and deeper about your revenue and cost levers in the long term to make it sustainable.
Yeah, I couldn't agree more. I mean, I don't want to quote from Advanced AI, the parent company of Atome, but usually when we work with firms in this space, 5,000-10,000 data points is where they need to start to build up a risk model. Getting 100 million data points doesn't necessarily make that risk engine more accurate, right? So the economies of scale question, I do thoroughly agree with that. We think there's more of a unit economics problem. Trasy, what do you think about this? Will consolidation continue to happen, and what's driving people to do it?
Yeah, definitely. I think we see a consolidation in any like high growth competitive industry, not just buy now, pay later, right? So I think in particular for Atome, buy now, pay later is just a start. It's not going to end here. And we definitely are looking at different ways to really bring that ecosystem and value to our users and merchants, so that we are able to really create the values and ultimately monetize from our users and merchants. So one of the example would be the Atome aspiration that we just recently launched to the Singapore market, where you'll be able to see the content created by different influencers, and the users will be able to go to the app and find out the new trends and new products. And from there, we are driving traffic to the merchants. And when I would say when the base is becoming bigger, that like Brad, that ecosystem is important. How do we actually drive that traffic and values to the merchant, and essentially really work out different campaigns with them and monetize them there? Could be one way. Or the other thing is, like, let's say Indonesia, we have P2P lending. That could be another revenue stream that we'll be looking at. So as I said before, it's not going to stop here. We're going to try out different things based on what the merchants and the users want in different markets in the region.
Very cool. Okay. What about you, Jenny, from Visa? Consolidation on the cards, payment companies buying BNPLs. We're seeing a lot of that.
Certainly, I also think there will be consolidations. I think, as if anyone mentioned there's a chicken and egg problem, there's a network effect going on there. So there's just economies of scale. I think the unit costs economics get better, right, as you grow bigger. So I think that is a little bit inevitable. I don't think a card scheme like these that will buy a payment company, buy now pay later fintech, just like our business model is different. We do four-party model. We don't really talk to merchants or consumers directly. So I think it's more likely to be financial institutions, banks, potentially, will have interest in the buy now pay later fintech.
Fair enough. No, I love it. You got agreement again in the background. Totally. All right. And then finally, we'll end with Carol. So what do you think around this industry consolidation point?
Yeah, I also agree that will be possible, right? Because I think first, economy of scale is one thing, but more importantly, I would say it's more the synergy on the business model, right? As what you rightly pointed out in the very beginning, in order to make the economic sense, I think the integration, the expansion is the focus, right? So to lower the cost. So I would say if there's any more, consolidation other than this economy of scale, would be the synergy on the business model. Right, so that there will be cost, I would say, economic, and also there will be more cross-selling opportunities, and it will be all about to shape an even stronger business model for that.
Very good. All right, well, that brings us to the last 10 minutes for Q&A. We have 2 questions that came through, and if any of you have questions, please type it in the Q&A, and I'll endeavor to pass it along to the panelists. I'll provide some perspectives if I feel there's any value I can add. But the first question is, how do BNPL providers increase their comfort with financing the traditionally defined unbanked population? And it's a valid question, right? People that traditionally can't get access to credit, why all of a sudden are you extending credit? How does that comfort come about? I think we've discussed some points around risk models and so on, but Dash, I see you just unmuted. Why don't you give us some color on this?
Oh, I think that's a very good question, and it's a question that when I joined Grab, I also answered. How do we actually break this? And it's been a fascinating journey. So I think credit is defined by a couple of things, right? Two things actually. One is your ability to pay, and the second one is your willingness to pay. I think ability to pay, the most direct way to get comfort is obviously you ask them for their salary slip, which also tends to be painful. So you need to find proxies which allow you to understand their ability to pay. Now we use a whole lot of transaction data to understand what could be a sort of ability to pay and get a sense of, you know, what their incomes could be. So that's one. Willingness to pay actually is fairly like, you know, you give them a certain line or a limit, and then they make a transaction, and if they pay back on time, it gives you some sort of comfort. I'm saying it in a little crude way, but that's the way to understand repayment. So if you have someone that you have, you get a comfort level on ability to pay and then they're repaying on time, that helps you to understand willingness to pay. And I think that's how we derive comfort, and that certainly doesn't happen over time. It doesn't happen immediately. It happens over time. It all comes down to the strength of your credit model, and it's a journey. And that way, BNPL is actually a great way to understand to go for the unbanked. You know, think about if you want to get a sense of willingness to pay by giving them some huge cash loan versus something more something which is, you know, a nice, really contextual payment credit product which allows you to understand. So I think yeah, that's how you understand. You get comfort in financing these unbanked populations.
I like the way you broke it down. It's kind of the ability to pay, the willingness to pay, and then the final thing I call it is forcing them to pay. That's where the collection side of the business comes in, right? That's the door knocking, pay.
Yeah.
I think just a challenge on that, and again, feel free, panelists, to open this up just as an open discussion. The willingness to pay. Usually with a bank, you know, your interest keeps going higher. You want to pay this down. You want to get this off your credit score. But with a BNPL, you switch you off. As Trasy said, I think it's responsible, right? You don't get people further into debt, so you're cut. And then they go, okay, I didn't get Atomia anymore. Let's go to Hula, and then let's go to Grab, and then let's just buy one product from each of these. I don't want to pay back anything. That willingness to pay point is slightly diluted because of the BNPL model, isn't it? And then how does that come into it? And then the collections point that I mentioned, I'm curious to get your views, because there are some concerns around, let's say, more unethical debt collection practices in certain markets in Asia, right? So, and it's not, I'm not talking from the perspective of the BNPLs, I'm just talking generally, particularly from the traditional consumer finance products.
Sorry, Ben, you want me to say yours?
Oh, anyone, open to all. Sorry, I should direct it. If Trasy, Jenny, Carol, or yourself want to respond, please do.
So maybe I can start. If someone else wants to go, but I'll take a couple of minutes. So I think that's interesting. That's an interesting point, Ben. And I'll speak about collections. I think collections, yes. You know, at some point, these are not very high ticket size loans. So collections don't become very cost effective after a while, given the size of some of these outstanding amounts. But, you know, again, there as an ecosystem, we do have maybe certain amount of leverage. We've probably not used it now, but we can choose to exercise it in the future. For example, I can disable cashless payments on Grab. I mean, that's a pain point. And someone who values that will immediately, hopefully, if they value Grab enough, they'll probably pay. Or tomorrow I'll ban them from the Grab app. If they value it enough, you know, at that point in time, they'll probably pay. And sometimes the people will not care and they will not pay back, which is fine. But hopefully those bads, when they come into the system and the profile attributes come into the system, it feeds into my model and it helps me to predict better in the future that I'm not going to get these kind of guys. So I think that's where the collective collections and the experience helps. And that's where BNPL is so great for, when it comes to catering to the underserved, because you get all these data so quickly and so frequently because of the way your capital turns. It really allows you to escalate your journey, your credit journey fairly quickly. And that's why in your first, I think 6 months, 1 year, it's important to have as many bads in the system as you have goods. So if you don't have the bads, you will not appreciate the good. And I think that's what that's what I think our endeavor is.
What about you, Trasy? I don't mean to throw you on the spot, but as another standalone, I'm always curious.
Right. Yeah, definitely. I totally agree with Dash. Actually, when we're looking at really offering credits to the unbanked population, we are not really going all out at first. We need to test it out. We give them a little bit of credits, and then we eventually build that up. And I would say that sometimes we do actually attract customers that a very small percentage of customers that might not want to pay us back, or might not have the willingness to pay us back, or might not have the ability to pay us back. But that amount, as long as it's operationally tolerable, then I think that's a price that we pay to really get that data and build an even better credit system to help us to understand the majority of the population. So totally agree with Dash there. And in Buy Now Pay Later does have given us a lot of insights, and not just through our platform, but also really working with some of the vendors in enhancing that risk system, and have really good data for us to build for the future.
Fair. Okay. Final question. I think comes in just generally BNPLs have amassed very sizable, affluent customer bases, some of them young, tech-savvy, repeat product buyers, and in some cases, previously vetted customers with high CLVs. There's financial institutions, research agencies, and so on, always looking for these kinds of customers for their products. So alternatively, target recommendations is also an option. Is there a scope for leveraging all this data that is being used, leveraging a huge volume of targeted consumer data and exploring this avenue? Maybe I'll just share just one quick perspective. Some of the BNPL firms that we work with, and you can all share or disagree, or they've said that we want to move away from being the actual provider, the credit extender, the person running this business, to we've developed such amazing risk engines. We have great eKYC tools. We want to sell this now. We want other people to buy. We want a bank to use our credit scoring tool to then start to service a long tail of customers that they've traditionally turned away. And we want to give them comfort around doing it. And I've generally seen this happen. It depends on the risk appetite of the institution that they're facing off against. A lot of the time, banks don't necessarily trust these models. So they tend to say, you run it, you wear the loss, you do everything for this amount of time. And then maybe at a certain point, we can wear the risk once you prove that it works with our end customers too. What are your thoughts, this kind of SaaS-based selling data model? Are there any final views on this before we wrap up? I guess that was the view. That's all right. But in my perspective overall, look, I think there is a big opportunity to leverage this data. And you see specialist providers out there, right? You see very niche firms focused on the credit scoring space. There's players like Jumio, there's players like Credo Lab, others that very much are centered on doing exactly this. And their whole business model is about building these engines and credit scoring and selling it to other people. Obviously, the challenge in then selling your own proprietary information is around customer data privacy, right? Will your customers be okay with you just monetizing their data and selling it to someone else? But yeah, in this day and age, who the hell knows where our data goes?
Yeah,
well, look,
maybe.
Yeah.
I just wanted to share a bit. I feel, in a lot of the open banking conversations I have, I feel a lot more firms are interested in consuming data than providing data. So there's a lot more people who wanted to get other people's data than really contributing it. So I think the challenge is everyone want to use it. Other people's able to acquire more users, and you don't really have that reciprocal market kind of happening yet.
Yeah, I fully agree. A very interesting space going forward. Now, look, final thing, I guess, for all the participants is we have 4 of the panelists that have left their contact details up here. You can take a quick screenshot if you would like to get in touch with any of them. But all these participants have extended, an open invitation for you to reach out if you want to say hello. Jenny, if you want, you can contact her on LinkedIn. She's available there. And all of our emails are here. And then Dash, is that also your mobile number?
Yes.
All right, we'll put you on some WhatsApp groups. We'll try not to spam your WhatsApp. But look, I just want to say thank you so much for all of you for joining. A huge thanks to our panelists for their time, their input. It's a very meaty topic, a lot of interesting developments happening in BNPL. I personally think it's here to stay, and I'm really, really curious to see how all of this is going to play out between the different types of providers that we are seeing in Asia. And like with any industry that's booming, you are going to see some people power ahead. You're going to see some people fall behind. Hopefully, these are 4 institutions that are part of this ecosystem that will continue to thrive in years to come. So a big thank you to all the panelists. Sincerely appreciate your time, your insights, and your input. And a huge thanks to everyone for participating. It's excellent turnout for today. I hope you have a good rest of the evening and afternoon ahead, wherever you are. And we'll make sure to post this online. If you want to download the report and see any of the things that we wrote in more detail that I presented at the start, just go to quinlanassociates.com and our insights page, and you should be able to find the report there. So once again, thank you very much. Have a good evening ahead. Take care and look forward to keeping in touch.
Thank you.
Thank you, Ben.
Bye, everyone.
Bye.
So,
Bye.